This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Which brings us to the Chevron deal. $53 billion, all stock to buy Hess Corp. Do we need much more to say, or should we just bring in the queen of all things?
Yeah, let's bring in Alix Steele. She's well known to our Bloomberg audiences.
Bring her in. She sounds amazing.
Oh, is that her?
You are amazing.
She's co-anchor of Bloomberg Markets on Bloomberg TV. She's been covering commodities for 16 years.
Since you were in the sandbox, were you not?
Yes, I'm that young.
No,
it's
but
amazing.
I'm serious. It's like amazing how long you've been doing this.
You dig deep enough
true.
in a sandbox and you hit oil, Carol.
You do.
With the right technology, it could happen. It could definitely happen.
What's going on in the energy space? Why are we seeing, first of all, big, broad, so much activity?
So on a broad level, basically, we know that we need oil and gas for some time. We don't know what that time is. Shareholders don't want companies to spend a boatload of money producing oil either. So the good solution for some of these guys are throwing off bazillions of free cash flow is to go buy stuff. So if you take a look at Chevron and Hess, they're getting a nice juicy position in offshore deep water off the coast of Brazil and Venezuela. They're getting some in the Balkan, they're getting some in the Gulf of Mexico. What they're not doing is spending billions of dollars for multi-decade projects that aren't proven. And that's what the industry is moving away from, but we still need the stuff.
So the $53 billion that they're spending to buy this is still a better deal than spending billions on E&P and trying to figure it out. And,
that would be capital discipline in a weird way. It's a different type of capital discipline. And you take a look at, say, Gorgon, which is an enormous LNG natural gas facility in Australia that Exxon built. Exxon was just starting it up about 9 years ago. And it still has problems, and it still has write-downs. That's what they're trying to avoid. Okay. And Hess was already doing a lot of things right in this area off Brazil.
Okay, well let's get to Guyana and the area that's in focus right now. The country is between Venezuela, Brazil, and Suriname, so those are the borders. Oil was only discovered within the last 10 years there. Why did it take so long to discover oil there? I mean, it's right next to Venezuela, and Venezuela's been an oil producer for years.
Yeah, but Venezuela is not the easiest place with which to drill consistently with oil from and explore, which is basically look at Chevron. Like, they're one of the main companies in it, and they just were able to ramp up production, but that's a hard time coming. I mean, exploring for oil, and this is a really simplistic answer, is really hard. I mean, it's not an easy thing to do, and it costs a lot of money. And this is a project through Hess, Exxon, and CNOOC as well. So it takes partnerships, it takes JVs to kind of do this. And it's hard. It's very tricky. And so it takes a while. Chevron wasn't in it. I've asked Mike Wirth many times, like, do you wish you were? Do you feel like you have to get in it? And, well, now he is.
I was surprised that Hess was down. Is it just, are investors not feeling like that they paid enough?
So
help me out with that.
So
I thought that they'd be up a bunch.
Is interesting because the premium on a stock level is like 5%. It's not that much. And the conversation on the call was a lot like, hey, don't you think you were worth more at this point?
Right.
But their stock was up like 94% in the last year. So it already had a really good run. So there's that. Also, it's an all-stock deal.
Right.
So you have to want to be in Chevron stock to like that at the end of the day. On a Chevron basis, why I think that stock was down is twofold. One is that it is an all-stock deal, so you're kind of saying that your stock is overvalued. I don't know. Some might say, some might not.
Right.
But also, you have to wonder what kind of upside Chevron can actually provide to the assets from Hess. Like in Guyana in particular, they're doing so many things right. The cost of development is so low, and they're doing so many things well. What's Chevron really going to do for that? Like when Exxon bought Pioneer, they have actual technology they've proven elsewhere that they're going to go and deliver to Pioneer as well, specifically, and that's why they did the deal.
So there was a strategy, it made sense.
There was a technical strategy. You guys do laterals this long, we do 4 miles, and we're going to bring those 4 miles to your wells. It's not the same for this. It's an inventory play.
You talked to the two CEOs. We have a little clip of Chevron CEO Mike Wirth and Hess CEO John Hess, appropriately, Hess,
exactly.
Earlier on Bloomberg Markets. Let's play it for everybody, and then let's talk about it.
In the short term, there's a direct correlation between world oil inventories and price. World inventories are drawing at about 1 million barrels a day this quarter. As you get to next year, we think demand's going to grow maybe 1.5 million barrels a day, barring a worldwide recession. Hopefully we don't get there. I know there are all kinds of geopolitical events. We think the market's going to be tight, and the supply side of the equation is going to have to run fast to keep up with the demand side.
That, of course, is the Hess CEO, John Hess, earlier on Bloomberg Markets. You and Guy Johnson talking with him, as well as Chevron CEO Mike Wirth. I mean, when you got into this conversation, you know this world, Alix, so well. I mean, beyond the Hess truck, which we've all had some fun with today. What was it that you really wanted to know about this deal?
So actually, I wanted to know why now? And how it came about. And also something that's interesting is the two of them seem to like each other quite well. Like the energy you pick up from they clearly are buddies. I wasn't necessarily expecting that because there have been other mergers in the past where I might not feel the same way about those energies. And I'm like, ooh, how's that going to go in terms of integration, et cetera? And I genuinely, in the interview, was surprised. I was like, you guys like each other. And they seem to really do. And I was interested in that part of it. Yeah. And then the why now. Like clearly, the bid-ask spread was wide. Clearly, it got narrow. So trying to get to that point was interesting for me.
Okay, two directions I want to go in. And I
but why did they say why now?
Basically, the bid-ask spread.
Okay,
that they finally agreed on price.
Carol.
Like it took a while, it took years, but they got there.
Okay, so two directions I want to go in. Is sort of,
Never.
ending with like the end of the era with the Hess family. An incredible story about the Hess business that has been built up. And of course, John Hess is expected to take a seat on the Chevron board following completion of the deal. What about when it comes to the energy transition, though? You started our conversation, Alix, by talking about investors don't know quite when that energy transition will happen. But what do analysts tell you about how much more oil we're going to use as a society before we're, hopefully getting to renewables at some point soon?
A lot.
Yeah.
I mean, a lot. I think that's the problem. No one knows, and no one knows the timing. So those on the left are going to say, it doesn't matter. Spend $53 billion in cash buying a wind and solar company and help that company get off its footing. And there is a point to that. Mike Wirth said the point was that actually they have invested in hydrogen. Drop in the bucket, though, when it comes to the amount of money that they're spending on Hess. However, if you'd like to go turn on your light bulb and you're not going to pay a boatload of money for your electric prices, we still need oil and natural gas. I mean, just in New York, you just moved to Park Slope, right? Yeah. The new law that you have to wind up moving to solar in the next couple years or alternative energies, that's going to cost an enormous amount of money. And this is liberal New York. And everyone in liberal New York is really mad about it.
And we no longer have a nuclear power plant to draw on, too, like we did a few years ago.
So unless you want to pay up for that, we still need the other stuff. I do feel like that conversation that these CEOs are threading has become a little bit easier in the last year and a half through the Ukraine war, et cetera, and energy security, particularly as the returns of green energy stocks have been terrible because their projects aren't making the kind of money that they think. Their contracts were signed 1 billion years ago, not really, but they were signed when things were cheaper, and then now yields have gone up, and now materials have gone up, and supply chains are still crushed, and they're just not making the money, and now you're seeing write-downs, you're seeing potential withdrawal of those projects, so you're not going to meet it. The targets you're not going to meet in the short term, so you're going to need the oil, and you're going to need the gas.
Yeah, there's a story I'm trying to think about, world's biggest carbon capture project. Oil major quietly ditched it. Occidental Petroleum. Like, it's just interesting to see the mix between fossil fuels and then moving to alternatives.
Right. So this is a great example, actually, about Gorgon, for example. Chevron, part of why they got the deal done in Australia was because they were building a carbon capture plant, and they are capturing carbon. Right. They're not capturing what they pitched that they would because there are a lot of problems with the project and the overruns, and every area you do this in can be different. Oxy's trying to do something a little bit different in that. They're trying to make it more modular, I guess. So like every carbon capture plant will be the same. They're taking parts from different companies that's proven, and then they'll just kind of like use it everywhere.
She's the queen.
I was like, are we done? Can we talk more?
You're the queen of commodities. She's the queen of so much. Love it. Alix Steele, unbelievable stuff on this deal.
Thanks, guys, for having me. I really appreciate it.
So appreciate her. Catch her every morning on Bloomberg TV.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
We know that there's a lot going on around the globe. We talk about it geopolitically and, perhaps rewriting some of the relationships that will shape global business and global markets for decades to come. With that in mind, in the BW Daily newsletter today, Bloomberg's Enda Curran gets into an unlikely geopolitical subplot of 2023, and that is the emerging view that China's economy, Tim, isn't going to overtake the U.S. after all.
I mean, investors get it. The China trade has been a painful one if you've been long, Carol. You've been talking about it for years. The NASDAQ Golden Dragon Index tracks Chinese companies traded here in the U.S. down 43% in 2021, down 25% last year, down another 8% this year. Absolutely brutal.
Yeah, it's an ugly trend line. So let's get to it. Enda is global economy reporter at Bloomberg News, joining us on Zoom from our Washington, D.C. bureau. And also with us, Ben Harburg is a managing partner at MSA Capital. They've got more than $2 billion in assets under management. The company, by the way, launching a new ETF focused on China. The firm is saying it's not just another China ETF. So I'm curious about this. Ben joining us on the phone on this Monday. But Enda, I do want to start with you and your, I feel like every day, flurry of stories on China, concerns about real estate, concerns about tech, oversight, the connection between companies in China and the government. Chinese authorities rallying foreign firms in the country again, a series of arrests across industries and an investigation into Foxconn, which we know is so important to Apple, their most important partner and one of the largest employers in China. So give us the backdrop of China. It just seems to get more and more questionable about the environment and also it being a growth engine to the world.
Yeah, it does feel like, Carol, this is the year sentiment really turned towards China's economy, rightly or wrongly. Now, if you remember a decade ago, you couldn't move people or money or investment fast enough into China, no matter what business or trade you're in. But a decade on, that story has changed dramatically, and the slowdown this year, along with the geopolitics, really is sharpening the focus on it. And in that vein, the New York Fed brought out a paper last week asking the question, can China ever catch up with Greece? And what they were doing essentially was running the numbers on President Xi Jinping has this ambition for China to achieve the mid-level developed economy status by 2035. So they benchmarked China against the advanced economies as defined by the IMF. And the poorest of those advanced economies would be Greece. Their per capita income is around $37,000 at the moment. China's is around 22,000, and the long and the short of the Fed's research was that it's unlikely that China can even reach the per capita income of Greece, given the scale of headwinds against the economy. And you mentioned some of them there. It's the demographic issues, it's the real estate bust, it's the heavy-handedness by the state, and it's just this idea that the China growth story is somewhat fizzling out now. Now, to be clear, there are still a lot of positives for China's economy. Highly innovative, leading the world in EVs and in solar power, for example. World-class infrastructure, very highly educated workforce. But the point of this New York Fed paper, and the point I think a lot of investors are saying now, is that won't be enough to get China where people thought it might once get to.
Hey, Ben Harburg, come on in here, managing partner at MSA Capital. You launching a new ETF focused on China. Do you agree with this New York Fed paper? Give us your take on what Enda just had to say.
I think it's a bit of a broad generalization. So you have, obviously, on a per capita basis, the numbers don't look great, but that's spread over a 1.4 billion person population. So it's not really a fair fight to compare it to Greece. What we try to zero in on are that emerging middle class, so that's 700 million plus individuals that are have discretionary income. And you look also at the top tier cities like the Beijing, Shenzhen, and even the second tier cities like a Qingdao. And in those cities, you see per capita incomes at that Greece or beyond level, and you also see still continued consumption. And so our job isn't to kind of try to get the entire economy and all the rural villages and populations up to that level. It's to find businesses that cater to that rising middle class and to go heavy in them at the right times.
Well, Enda, so address that. You do wonder, right, in terms of a developing nation, although I always feel like China is a developing nation, but it's much more than that. Do you need to focus on, there are some parts where it's kind of off the charts in terms of how much progress China has made in its economy in some of those specific cities versus others?
Yeah, and the population point that your guest just made, by the way, it's a perfectly good point that your guest just made. And also just to say, by the way, Carol, that there is an argument that the cyclical slowdown in China this year has been exaggerated. And one of the interesting things that I've observed watching China from this part of the world is that global markets this year didn't really react to what's going on in China. I mean, iron ore was trading at around $100 this summer in the middle of China's, annual crisis, so to speak. Even though the yuan was at its weakest since 2007, we didn't see the kind of volatility that it might have once triggered in global foreign exchange markets. And I think there's a view that in the consumer story, even though it didn't rebound back to what was expected in the post-COVID zero kind of world, the consumer story is still strong in China. And even as China's economy grows slower, it's growing on a much bigger base than it was even a decade ago. So slower growth on a bigger pie. So to be clear, and the Fed paper as well, I should say, they do make it clear there is a positive case to be made for China's economy.
Hey, Ben, come on back in here. As we mentioned, MSA Capital is launching a new ETF focused on China, but the firm argues that it's, quote, not just another China ETF. So what exactly is it?
Well, so what's defined most investors' reluctance to get into China when it comes to non-fundamental issues? So there's obviously a fair bone to pick with China on the economic front. But when you think about those folks that are convinced still of the China upside, the long-term growth story, again, that scale of the middle class, the fact that many of the fundamentals are still in our favor, that we're a third of the U.S. credit card debt per capita, that our interest rates are still, only about 3.5%. The scale of our GDP, the pace of our GDP growth at scale. So if you're convinced of that economic story in the long term, there are still folks that are running away from the market for non-fundamental reasons, and they fit into two baskets. Either they don't trust the Chinese regulatory regime, and they just feel like it's unpredictable as to what will come down the pipe in terms of how they adjudicate upon sectors or principles in large technology companies. And then they're also, of course, fearful of geopolitics. They're fearful of investing in Chinese companies that might have dual use kind of civil military fusion applications, both that contravene American value, that challenge American technological or economic supremacy. And so what we've tried to do is address both of those with this ETF. So on the China front, we have over 15 investment professionals on the ground in China. We've invested over $2 billion there and effectively navigated over the course of the last 7 years away from all of the regulatory hotspots. We didn't invest in the education technology space, or we didn't invest in peer-to-peer lending or gaming, the sectors that the government had kind of cut down upon. And we did so for very systematic and thoughtful reasons, years ahead of schedule. Likewise, on the U.S. side, the way we navigate that and help our investors not fear being called up in front of their investment committees or their investors on again, those kind of national security or moral grounds is we've instituted a political risk board of ex-White House officials, government, military officials, people from Treasury and Commerce that help us screen all of our companies in our portfolio. Obviously, it's table stakes that they're all high alpha businesses, but we screen them for whether or not downstream or upstream military applications, anything that contravenes U.S. values.
We were talking with Enda Curran, global economy reporter at Bloomberg News, has a great column out in BW Daily looking at China and some research out of the Fed. And then we also have still with us Ben Harburg, managing partner at MSA Capital. They've got $2 billion in assets under management. They're just launching a new ETF focused on China. Ben is on with us on the phone in New York City. What I love about when we've got two people and we're talking about China, what's going on in terms of the economic backdrop, and also about as an investment opportunity. I love for our audience when we've got two people kind of coming at it from different angles. And I want to ask you, Enda, do you have a question for Ben in terms of as they are launching this new fund and looking at the opportunities in China? And as you know, China has been, I feel like, the holy grail since I started my career in business news several decades ago. But everybody wanted to have exposure to the Chinese market because it was so vast and the potential to make money.
The demographics alone, Carol.
Exactly. So, Enda, do you have a question for Ben?
Sure, thank you. Ben, all your points are well made. I wonder, what do you think of the political control in China now, quite apart from the economics? Do you have any concerns about the heavy hand of the state or some of the developments we've seen in recent years and months that might ultimately impact China as an investment destination?
It's certainly impacted the way people perceive China. And at the end of the day, the reality on the ground doesn't matter if people in New York and London and Washington aren't convinced of the reality. I believe that in China, there's a Faustian bargain between the government and the population. You get certain civil liberties in return for a better tomorrow when it comes to economic advancement. And that the government side of that bargain hasn't been met over the last year. A lot of it undermined by zero COVID and the perception they could organically, without significant stimulus, kind of elevate the country out of the economic doldrums that we faced over the last couple of years. I think they're kind of starting to get that message. It's been a drip feed of stimulus to date. We were actually a little disappointed with the economic numbers that came out of Q3, just because they weren't bad enough that they might force the government's hand. But overall, I believe that the government has to and will continue to stimulate the economy, keep up their side of that bargain, even if from the outside it seems like they're taking back control, they're reducing the power of the private sector. At the end of the day, the economy has to move forward, and they have to match those growth numbers.
Well, and to pile on what Enda said, Ben, we did talk about the story about China authorities, a series of arrests across some industries, including, I guess, an investigation to Foxconn technology. Anybody who listens and watches Bloomberg knows this company so well, Apple's most important partner and one of the largest employers in China. So when you have stuff like this come out, it's got to be, Ben, a little unsettling for investors again about okay, now what?
Certainly. And again, one of the biggest flaws, I think, in the way that they manage their economy is they don't do a good job of forecasting, foreshadowing, and explaining the rationale behind these investigations or interventions, why they've taken certain kind of measures against whole industries or certain companies. It's just very poorly communicated. And maybe that's growing pains. Obviously, it's probably a little mature to not have refined that to this point. But that's, I think, what things struggle with. And that's, again, why it's so hard to trade China sitting in New York or London or even Hong Kong. You have to be on the ground physically near the regulators with a close ear to the ground to understand why things are happening and get well ahead of them.
Ben, wanted to give you a chance to do the same thing Enda just did. Enda, of course, global economy reporter here at Bloomberg News. Feel free to throw a question his way.
I'm curious what your bull case is for the Chinese economy over the coming year. Our view, obviously, is that we're in kind of a counter-cyclical environment now where maybe China is about where the U.S. was in 2020. Curious how you view and what upside you think comes.
Well, one of the interesting things, I think, post-COVID zero, there was a huge expectation, Ben, that China would have a V-shaped rebound, and that's now disappointing people. But actually, I think that disappointment might be overstated because we forget that in 2020 and 2021, China had a pretty good pandemic, right? When the rest of the world was falling over, China's exports were going gangbusters, the consumer was doing okay, and that even lasted into 2022 before things obviously started to unravel. So I think the framing of the downturn in China this year needs to be just recalibrated a bit, that yes, it wasn't the kind of Western pent-up demand V-shaped rebound, but actually on the ground, the consumers not doing as bad as I think popular perception might make out. And the other point I would say is that if they can fix the real estate story, then at least on the macroeconomic side of things, if that can at least bottom out, I think that would be a big part of the turnaround story in China. What I would say, though, I think the political story and the security story, that's a whole other issue. And I think that's the big question mark over the broad China outlook right now.
Yeah, it's really fascinating. I'm, as everybody knows,
we're going to talk about that a little later, too.
I'm obsessed with 60 Minutes did it, the Five Eyes, the spy chiefs in the U.S., in the U.K., in Australia, Canada, just concerned about the role of China in really industrial espionage, basically, and seeing that as our big threat going forward. But we're going to get into that a little bit more later on. Ben, I want to go back to what you said earlier about, your team on the ground and what they are seeing specifically. And then you talked about this political risk board. So I'm curious what your team on the ground is seeing specifically and what the biggest risks are when it comes to Chinese investing, according to your board.
So on the China side, obviously the biggest risks we're looking out for are the kind of ongoing trends within the Chinese regulatory infrastructure, and those are antitrust. So them coming back and regulating some of the larger tech giants and those that have achieved kind of monopolistic control across a wide array of sectors and gotten a lot of licenses that they probably wouldn't be granted in the West. We're also looking out for companies that appear to be kind of predatory or addictive. So that's gaming companies or people giving high interest loans. On the U.S. side, what we're looking out for are companies kind of that downstream or upstream in terms of their supply chain or downstream customers are using that technology for military application or are using that technology to kind of perpetuate any of those things that will counter American values. So surveillance, human rights abuses, things that are coming out of Xinjiang, for instance, something along those lines. So that's where our sensitivities lie. And we're actually weeding out a lot of companies that other ETFs and other fund managers have very heavily traded in their portfolios just because we know that there are some skeletons there.
So, Ben, what's left after you weed out all that?
It's a lot of weeding.
Surprisingly, quite a bit. So that, we've got a ton of companies in the consumer discretionary spending space, so beverage businesses and QSRs and and other entertainment and travel businesses. There's a lot of businesses in the industrial space that are involved in improving the efficiency of the market as human capital costs have gotten higher. There's businesses obviously still in the technology space that are not falling afoul of those. So we actually have hundreds of companies to choose from, and we're whittled them down to about 40 on an active day-to-day traded basis.
I do wonder too, and when you look at the Chinese economy in terms of, we talk so much about, certainly for the market cap, these big tech cap, big mega caps, I should say, names that really move the U.S. market overall. But when you look at the Chinese economy, the companies that really move the needle and really are responsible for so much of the growth are what today?
Well, I need to check the composition, but like the SOE companies certainly make up some of the biggest weightings on the stock market over there from memory, other than the tech companies, But this was the point I was trying to make earlier on, that I haven't seen that transmission from what's happening in China this summer spill over necessarily into global financial markets. If you'd stopped me earlier in the year and said, the China real estate crisis story wouldn't be getting any better, that the economic recovery broadly would be quite disappointing, that the yuan would have sank the way it did, etc., you would have said, wow, there'll be there'll be spillover, keep an eye on iron ore prices, keep an eye on what's happening in regional currencies, etc. But it hasn't played out like that. So I think people are able to square off what's happening in China's economy right now. They kind of understand that part of it. The black box, or the unknown, for me, as I've said earlier, is going to be the political story and how that plays out, Carol.
Hey, so makes sense. Hey, Ben, saved about 30 seconds for you. You talked about your approach for the fund or for this ETF that you guys are launching. What's one company that really kind of just is very representative of that strategy? And again, got about 35 seconds.
Sure. So a company like Miniso, which is a chain, a little bit like Uniqlo or something like that. They also sell home goods, so low-cost fabrics and clothing and homewares, but one that, again, has a global footprint. They're operating in all kinds of markets that even the Targets or whatever of the world would struggle to sell in. One that we don't find controversial, and one that has been growing like mad over the course of the last year and done very well on the stock market.
I love that. It's not a name that we talk about, but it's going to make many
about
of us...
3% of the ETF.
Yeah, love that, and make many of us search on it and check it out. Guys, thank you so much. Great round the world when it comes to China. Ben Harburg is a managing partner at MSA Capital. We mentioned $2 billion or more than $2 billion in assets under management, and launching a new ETF focused on China, and the ticker is CGRO. And of course, our Enda Curran, incredible global economy reporter at Bloomberg News, joining us there from our Washington, D.C. bureau.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We are now in our third week of the Israel-Hamas conflict, still wondering if this becomes much a wider conflict in the region and beyond. We've seen also Chinese President Xi meet up with Russian President Vladimir Putin. It's a reminder of that growing and yet complicated relationship. And then, Tim, of course, there's the Ukraine war well into its second year, with concerns about the U.S. and maybe some others growing wary when it comes to supporting it as it gets ready and looks likely to enter a third year of conflict.
All of this raises questions, Carol, about global alliances. And we're not just talking about military alliances.
Right.
We're talking about economic alliances and other alliances as well. A voice that we lean on to figure it all out for us is Ed Price. He's a former British trade official who represented the UK government to Wall Street. Now he's also advised members of the European and British parliaments. He now serves as principal for geopolitical forecasting at Ergo. It's the global intelligence consulting and forecasting firm that correctly predicted a Russian invasion back in early 2022. He joins us on Zoom in the Hudson Valley. Ed, good to have you with us. How are you?
How are you doing? Thank you.
We're doing well. I wanted to just highlight a couple of the stories and pieces that you've written lately. One of them is about the choice that Israel faces. Does Israel actually face a choice right now?
Well, operationally, no. Israel must seek out and destroy Hamas. I think that much is obvious. I think the question is perhaps how exactly Israel does that. And that's a two-pronged question. On the one hand, any sort of ground operation in Gaza is going to be devilish. It's going to look like Stalingrad, I'm afraid. But on the other hand, of course, Israel's fighting a multi-dimensional informational PR war against Hamas and the allies of Hamas, essentially Iran and Hezbollah. And by that, I mean, if Israel does something or does things that its opponents can point to and say, look, Israel is completely out of line, it would have lost the war in the information space, which is dangerous.
How have you been thinking about this over the last couple of weeks and as it evolves? And I guess we're all waiting, as you know, Ed, fingers crossed it doesn't become wider and deeper in terms of scope, but, you know, we're all a little bit nervous about that. But how have you been thinking about it as it has gone on these last couple of weeks?
Hey, Carol, hope you're doing well.
Yeah, thank you.
It's a difficult one, Carol, because I've been thinking about the First World War. And whenever you study the First World War, of course, you have to remember that people were surprised and that the alliances that were underpinning the relationships between states were invisible before 1914, before the conflict began, but then very rapidly became clear. And so what I'm thinking about is, what are the alliances, what are the fault lines between powers? And if you go around your mental map of the Middle East, Israel is in a bit of a pickle, right? You've got Oman and Yemen. I don't think that they're friendly. You've got Lebanon, you've got Syria, you've got above that Turkey. Who knows what they'll do in this situation? They don't seem like they want to do anything to offend wider Muslim opinion. You've got Saudi Arabia now, which of course has said that it's not going to do this deal, or we hear that it might not want to do this deal with Israel. And then of course behind everything, Iran.
So what's the question with Iran? I mean, how does the U.S. navigate that?
I mean,
notice I said U.S. and not Israel.
Yes, I noticed that. I think that's smart. We know how Israel feels about Iran. If they could, Israel would hit Iran where it hurts, which is wherever those nuclear facilities are. And I think they probably should at this point. That aside, US has to look at Iran now as essentially a franchise of Russia. Because the way that the Iranians have timed their support for Hamas, and who knows, also possibly Hezbollah, can only be something that benefits Putin and the Kremlin in their endeavors in Ukraine. I mean, let's look at this rationally. All of our attention has shifted away from the European theater to the theater in the Middle East. And whilst I can't prove any collaboration between Russia and Iran, I would bet my bottom dollar that there is one.
So is it very smart then, you think, that, Ed, that President Bush was tying aid, if you will, kind of all together? I mean, sorry, I keep doing that. I don't know why I keep doing Bush.
He did speak on this last week.
President Biden, forgive me, who did speak about this in terms of aid for Israel, in terms of aid for Ukraine, and then also kind of throwing Taiwan into there and the concerns there in that region. Smart for him to kind of tie it all together?
Well, I mean, I don't want to get partisan on your show, but I think that President Biden's foreign policy has been pretty good, honestly. We've been fighting autocracy in Ukraine, essentially using NATO surplus equipment. He has avoided so far any real escalation in, as I say, the European theater. And then he moved the two carrier groups into the Mediterranean, which I thought was very bold. But again, President Biden is a multidimensional foreign policy thinker. And he is clearly thinking about trying to restrain Israel from that trap that I think the intelligence community has also been warning about in the West. And that trap is the perception of overkill in Gaza. Remember that the autocracies would love to see us do things that they can point to as war crimes. They would love to see the West censor its internet, and so on and so forth, in order that they can draw moral equivalence between how they run their societies and how we run ours.
And I'm curious to get your thoughts on just your reaction that the ground invasion of Gaza that we thought was so imminent has not yet occurred.
Well, my best guess there, and I stress best guess, this is speculation for your audience, is that American diplomatic efforts bore fruit, and that President Biden meeting Netanyahu in person was effective in so much as there was at least a pause. I don't think that Israel or any other power would conduct a major escalation of a war while a US president was in their territory or in any way endangered. So I think that was probably effective. On the other hand, I wouldn't hold your breath, because I do feel that Israel will continue to pursue Hamas. We must remember that Hamas conducted a grotesque terrorist attack on Israel, completely unprovoked. It was complete disgrace and some of the most disgraceful and disgusting open source material I've ever seen, and I'm an old hand. So this was very much Hamas's aggression against Israel. Israel has to do something.
I want to go to this piece you did in Barron's, which you've touched on some of this, but this idea of this democracy trap, and talk to us a little bit about it, because it sounds like what happens is then we kind of really do miss either the development of certain strategic alliances, and it can obviously run afoul, as maybe we're already seeing as it's played out in this world in maybe the last couple of years or so.
Mm-hmm. Well, you know me, Carol. I'm always desperately seeking some sort of analytical fame, and I make furtive efforts at catchy articles and titles and so on. The democracy trap is simply the idea that you're damned if you do and you're damned if you don't when you're a democracy. If you do not punish your enemies in a way that other empires and other autocracies in the past have shown is effective, then you are, on the one hand, maintaining your morality as a democracy, but on the other hand, you're letting them go. You're letting them get away with things. And flip that around. If democracies do go ahead and apply firepower to their blood enemies, people turn around, as I said before, and say, well, what kind of democracy are you if you don't care about human rights? And I'm afraid we've now tangled ourselves up as the West, as democracies more generally, into a position, and perhaps this is a legacy of the Vietnam War, perhaps it's a legacy of the Afghanistan War, I don't know, but we don't seem willing to really hit our enemies hard. Now that's a problem, because at some point we're going to have to, and very unfortunately, it appears that the next time that we're going to have to will be Hamas. Hamas has embedded itself in a civilian population. Mm-hmm. Some of those people support Hamas, a lot of them don't, and half of them are children. So again, let's go back to Putin. He would like nothing more than to see Israel, the US, the UK, and others, whether in reality or in perception, doing things that he is doing in Ukraine so that he can point to us and say, there's no difference.
So here I want to take the step of, some of your past history where you represented the UK government to Wall Street and the US. And I think about, Ed, the tricky relationship of global companies to China, to the Middle East, Saudi Arabia, right? We know the atrocities that have happened, and yet we continue to do business. And I understand the thinking of, well, if we're involved, we can help make things better. Okay. But that doesn't often happen. So I'm thinking about our investment audience who are listening to you, and I'm just thinking, okay, so are companies doing what they should be in terms of standing up for democracy if we really believe in it? Or will they never, because they have business interests in so many of these difficult regions of the world?
Well, I don't know if they will or not ever, but right now, no, they're not. And sometimes I scratch my head in the wee hours when I think about the blood, sweat, and tears that's gone into ESG, and wonder, to your point, Carol, about where the equivalent is for human rights and democracy. I mean, human rights and democracy scores, right? We have that around the edges. We have a sort of center-left tradition of protest in some Western countries. We have Amnesty International. A lot of business leaders themselves, regardless of their politics, are upright, have integrity, and want to do the right thing. But we are exposed to countries that mistreat their populations. We purchase things that were, possibly made in circumstances that we shouldn't really accept. That's the old Naomi Klein book, No Logo. But moving on from that, we now know about the Uyghurs and other egregious human rights issues in the world. But look, it's very difficult. I mean, if we've got, for example, Western financial services positively exposed to Chinese growth, if we've got other firms in the world, I mean, look at semiconductors that are essentially just trying to do business to keep the modern economy running, I imagine that they're hoping that the international geopolitical outlook will calm down somehow. My fear is that it won't, Carol.
Yeah.
I mean, I think that's a valid fear given what we're seeing, Carol.
Yeah, it feels like it's just going to get worse. Like when you talk about, some similarities from the First World War, like I just think we're just at this very, go ahead, Tim.
Well, I was just going to say, just to piggyback on that, Carol, I mean, Ed, it seems like the U.S., some people would argue that the U.S. is engaged in a proxy war with Russia. I've heard that. And and again, not necessarily my view, but I've heard that argument. And then I've heard the argument too that the U.S. is finding itself drawn into this latest conflict in the Middle East by actually having a carrier, or I should say a military presence there just off the coast.
Right, Tim. Right, you are. So maybe we should be talking about Bush, right? And both Bushes.
Good point.
Because Gulf War III may be just around the corner.
Do you believe that though? Are you being facetious, or do you believe that?
Yeah.
I'm not being facetious at all. No, I'm sitting here on your radio show. I think that that's absolutely possible. I'm very concerned, and you have to be careful with these things because, like I said in these articles, if you're someone who worries, then you're going to get accused of crying wolf, and rightly so. If things don't go the way that they might be going, but let's play it out quickly. Israel goes into Gaza, Hezbollah thrusts into the north. There's a second, third, fourth, sixth, whatever intifada it is in the West Bank. At the same time, Iran decides now's a good time for some sort of global activation of any terror networks they have. Bob's your uncle, right? Immediately, you've got to get the only real cop in town, the only real cop in the world, which is the United States, involved somehow in the Middle East. Now, again, if I was an adversary of the United States, I'd be thinking, well, all I need to do is a third one someplace, and I can go and take Taiwan.
Exactly. Which goes back to President Biden in his speech and kind of tying all of this stuff together. Ed Price, so appreciate it. It's a heavy Monday, but you really have tied it all together for us, the things that are facing investors, yes, but really the world at large. So good to catch up with you. Look forward to having you back in studio real soon. Ed Price, we have reached out to him often on these times of uncertainty. Former British trade official, we've talked about that. He's principal of geopolitical forecasting at Ergo. It's a global intelligence consulting and forecasting firm, joining us on Zoom in the Hudson Valley. That's our backdrop on
It's a little concerning.
But, the idea of, distracting us in different spots around the world, and you think about, okay, where does that lead us then ultimately? And what will the U.S. do? Does it get involved all over there? And then does it mean, you kind of have a world at war again? I
mean, the term involved certainly means different things. I mean, if it's sending money, yes, the U.S. has been involved in,
troops on the ground are another thing.
Exactly. That's
all right.
The question.
Our thanks, as always, to Ed Price over at Ergo. All right, don't go anywhere. This is Bloomberg.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
You drive me crazy.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, let's get to it. Just got about just under 18 minutes left in today's trading session on this Monday. Carol Massar along with Tim Stenovec on radio, on TV, on YouTube, on Bloomberg Originals. Actually, we're coming up on TV. Just giving a little
Maybe we'll get there.
Maybe. Get there.
I don't know. It's a little dicey.
It is a little dicey. It's also volatile. I mean, we just, Charlie and the team, and Bill Maloney just cracking down the trade. Volatility as that 10-year Treasury hits 5% for the first time. Our next guest still believes equities are there for the long-term play. So let's get to it.
Yeah, we are very pleased to have with us Ann Miletti, head of active equity at Allspring Global Investments. She joins us here in the Bloomberg Interactive Brokers studio. Deep breaths, because that's what I think this market needs. Certainly, a confusing trade today with the losses that we saw this morning flip to the other side. What's your take on everything, Ann?
It's hard to have it's hard to have a lot of conviction, I guess, in the big picture because there's so many variables, there's so many things changing and a lot of surprises out there. But I think what we really believe is that we are in a new paradigm, if you want to say that,
yeah.
Right where we do have higher inflation, likely for longer, higher rates, likely for longer, and that means that investors have to, it's a different playbook than we've had in the past. You have to be more careful. You have to select the stocks you want to own. And we are focused much more on quality. I know that's something that you hear often from people, but it is much more meaningful to do that today than it was before.
What's quality mean?
Good question. Carol, because that word does get thrown out a lot. I think for me and a lot of our teams, what they're focused on today, balance sheets, free cash flow, management teams that are proven, right, that have gone through difficult periods before, managed their companies well through it, through strategic change or macro environments that have been tough.
Can I throw out one name like
Yes.
Netflix, which
Yep.
we were all blown away
Yep.
by their free cash flow and just kind of a standout when it comes to the streaming business. This is
It took a
company-
while for Netflix to get there.
Exactly. But is that something then that you say, and I know that's one of those bigger mega cap
Yep.
names and stuff, but
I think if you look at any type of company that throws off good free cash flow, and why I said in the beginning it is a metric for quality, it gives a company flexibility. Balance sheets do, strong balance sheets do, but free cash flow does. And look at, the example you gave is a good one because it's a company that has been able to reinvent itself and pivot. And I think, you don't know, none of us know exactly what lies ahead, but given the ability to pivot is really important.
What's a world with the 10-year at 5% mean for equity investors?
I think it means that it's going to be tougher, that there's no free lunch, that not everyone's going to win, not all companies are going to work. And so you have to be selective. I do think that, it is a benefit for active managers. And look, I've sat in the studio
Active managers would
far
say that,
too many
though, right?
times, right? Far too many times, and
we
I
have a
know
story
I'm
on the
biased.
Bloomberg about a lot of
Active managers are facing a tough slog ahead right now because the past few years for mutual funds has just been brutal.
It has been, and I look at the flows, but I think this is what's challenging. We are the beginning stages of this paradigm shift, right? Where you have higher rates and higher inflation, and we haven't seen that in such a long time. But what that drives is a challenging environment for companies, and it doesn't work to just throw darts anymore. It doesn't work to own an entire index anymore. You have to be selective in what you own. And so I do think you're going to see a switch. And look, it's up to us to prove it. You got to drive performance through stock selection. And so, we're starting to see that.
And I know you can't whittle down into specific names, right? But can you give us an idea of areas that you think investors should be checking out here and then doing their homework on?
Yeah, I do think, the Russell 2000 hit a 52-week low.
It's gotten
beaten up. Now, some would say it's leading us to maybe the fact that we are close to a recession. I would say risk versus reward is starting to look more favorable. We know that small caps do go down ahead of a recession, but coming out of a recession, they do really, really well. So might be a little early, but I would start selectively choosing names in the small and mid cap area. I also think healthcare, very beaten up, hasn't worked well. Multiples, again, of select companies that are really high quality.
Does that include
very
pharma
good.
and biotech? There's been so many companies picking up some of these biotech names. We've seen a lot of M&A activity.
Again, I would say select biotech that has the capital available already, that they don't need to go out and, get more capital, but they might have drugs that throw off free cash flow. Med tech also looks interesting. That's another area. Again, the other defensive areas, staples, underperformers.
What is your outlook for a recession?
I do think, again, it's coming. It's not, is it coming? It's when it's coming. And that's been, everybody, I'm humble enough, right, exactly. I'm humble enough to say, I don't know. Nobody knows. I wish I did, right? But we don't have the crystal ball. I do think there are some challenges out there. And, living in the Midwest, I can tell you, it does feel like a lot of my friends' family would say they're in one today.
A recession.
Yes. And so
because they're out of work, because they're underwater, because
they're
they're so
expensive. Because we're not seeing this in the jobs data.
No,
but that's why I'm curious.
Yeah,
how
not
they
seeing it in the
recession?
jobs data, but car payments over $1,000. Their house payment hasn't, for the most part, been affected yet. However, I have several friends that don't own a home, that want to own a home that are locked out. They feel like maybe forever now, and so. In food inflation.
So it's very telling.
Yes. And so, if you are living on a budget and you don't have a savings, it's a really, really tough environment. But again, we talk about the consumer and the consumer strength. If the consumer is really starting to feel the pressure more broadly than just a handful of people, and it is getting tougher, that is a problem, because the consumer has been kind of the strength and the backbone.
Is it? We only got about 25 seconds. Is it kind of a little wacky, like the strong retail? Or do you look at that and you're like, this makes no sense to me, from what I'm hearing more generally?
It does, and I think we have been thinking, the high-end consumer's been holding it up, but look at some high-end retailers. They have been telegraphing they too are seeing softness. So again, the numbers we've seen are the numbers behind us. We'll see what the numbers going forward look like.
God, I feel like Gina, very
dour?
A little bit, yeah.
That being said, I would say there still are opportunities in equity. Long term. The economy, it's hard to be bullish.
Sorry, Ann, we don't have any time for good news.
I know.
I'm sorry, we're out of time.
We don't have any time for the bullish side of you. Ann Miletti,
come back,
always welcome. Head of Active Equity, so solid. She's at Allspring Global Investments right here in studio. Be well, kiddo.
Thank you.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.